Here's a fact that should make every stock picker uncomfortable. Over 90% of professional fund managers, people with Ivy League MBAs, Bloomberg terminals, and entire teams of analysts, fail to beat a simple index fund over 10 years. Not some of the time, over 90% of the time. So let me ask you something. If the smartest, most well-resourced people on Wall Street can't consistently beat the market, what makes you think you can? I'm not saying that to be harsh. I'm saying it because nobody told me this when I started investing, and it cost me money I didn't have to lose. Let's talk about what's actually going on here. When you pick individual stocks, you're essentially betting that you know something the market doesn't. Think about what that means. The stock market has millions of participants, hedge funds, algorithms, institutional investors, all processing information 24 hours a day. Every publicly available fact about a company is already priced into the stock. So when you read a news article about Apple's amazing new product and think, "This looks good, I should buy," you're not getting an edge. You're getting information that institutional investors and high-frequency trading algorithms acted on hours, if not microseconds ago. By the time that news reaches your screen, the potential profit has been absorbed into the price. You're the last person to the party. This is the core idea behind the efficient market hypothesis. In simple terms, it states that a stock's price reflects all available information at any given moment. And while academics can debate its finer points, the practical implication for the average person is brutal. You cannot consistently beat the market using publicly available data. The game is rigged, not by conspiracy, but by speed and information. This means for most retail investors, stock picking isn't really investing. It's gambling with extra steps. You do research, you read charts, you feel like you're making a skillful decision. But without a genuine informational advantage, you're just pulling a lever and hoping for the best. Now I know what you're thinking. This sounds too cynical. What about Warren Buffett? What about the people who got rich on Tesla or Amazon early? We all know someone or know of someone who picked that one magic stock that changed their life. Here's what nobody tells you about those stories. For every celebrated winner, there are thousands of forgotten losers who bet on the wrong company and quietly lost. This powerful psychological blind spot has a name: survivorship bias. It's a story we all love to hear. The visionary who bought Tesla at $30 and made a fortune. It's compelling, it's inspiring, and it makes us think, I could do that. But this is a classic case of survivorship bias. For every celebrated winner, there's a graveyard of forgotten investments. You don't hear about the thousands who poured their savings into Enron, Kodak, or Blockbuster, companies that were once titans of their industries, considered sure things, right before they went to zero. Their stories are silent, buried by the headlines celebrating the rare, spectacular successes. This isn't just a media problem, it's a human one. Our brains are fundamentally wired to focus on the wins and conveniently forget the losses. It's a cognitive shortcut that makes for good stories but terrible strategy. The financial media amplifies this instinct tenfold. They have no incentive to cover the mundane, cautionary tales of failure. Instead, they parade the outliers, the lottery winners of the stock market, presenting their luck as a repeatable formula. They only cover the people who got it right, creating a distorted reality where winning looks easy and common. To understand this, imagine a simple experiment. You put 1,000 people in a stadium and have them all flip a coin. After the first toss, about 500 will have heads. They stay, the rest sit down. You repeat this. After 10 rounds, probability dictates that someone in that room will have flipped heads 10 times in a row. Would we call that person a coin-flipping genius? Would we write books about their technique? Of course not. We'd recognize they were just the one who got lucky. Stock picking works the exact same way. With millions of people trying to beat the market, some will inevitably succeed through pure chance alone. But because we only see the winners, we mistake their luck for skill. So what's the alternative? Index funds. An index fund doesn't try to beat the market. It just owns the entire market. When you buy an S&P 500 index fund, you own a tiny piece of the 500 largest companies in America: Apple, Microsoft, Amazon, Google, and 496 others, all in one single investment. When the economy grows, you grow with it. You don't need to pick winners. You just need to be in the game. And the returns are not modest. The S&P 500 has returned an average of 10% per year over the last 100 years. Through recessions, crashes, pandemics, wars. 10% on average. $10,000 invested in an S&P 500 index fund 30 years ago would be worth over $174,000 today. Without picking a single stock. Without watching CNBC. Without stressing about earnings reports. Just owning the market and letting time do the work. Now let's talk about the part that actually infuriates me. Fees. When you invest, you'll encounter fees. They're an unavoidable part of the financial world. But not all fees are created equal. Consider the actively managed fund, the kind where a professional fund manager and their team of analysts are actively picking stocks, trying to beat the market for you. For this service, they typically charge between 0.5% to 1% in annual fees, known as the expense ratio. That sounds tiny, a single percentage point. It's designed to. But in the world of long-term investing, it is a catastrophic drain on your wealth. This isn't just a fee on your initial investment, it's a fee on your entire portfolio, year after year, creating a powerful, compounding drag that works against you. Let's make it concrete. On a $100,000 portfolio over 30 years, a seemingly harmless 1% annual fee will cost you over $100,000 in lost compounding returns. Think about that. You end up paying the fund manager more than your entire initial investment, just for the privilege of their management. Now, compare that to a simple index fund from a provider like Vanguard or Fidelity. These funds don't try to beat the market, they simply aim to match it. Because there's no expensive team of stock pickers, the fees are minuscule, often just 0.03% to 0.05%. This means you're paying 20 to 30 times more for an actively managed fund that, statistically, is very likely to underperform the cheaper, passive alternative over the long run. This isn't a secret kept from the public, it's a well-documented reality. Warren Buffett, one of history's greatest investors, made a famous $1 million bet. He wagered that a simple, low-cost S&P 500 index fund would outperform a hand-picked portfolio of hedge funds over a decade. The hedge fund managers, with all their expertise and resources, couldn't overcome the drag of their high fees. Buffett won. Easily. So here's the practical takeaway. If you're just starting out, or if you have money sitting in actively managed funds right now, here's the simplest investing framework that exists. It's called the 3-fund portfolio. Fund 1, a total U.S. stock market index fund. Fund 2, a total international stock market index fund. Fund 3, a bond index fund. That's it, 3 funds. Rebalance once a year. Don't touch it. This portfolio has outperformed the vast majority of professional investors over every 10-year period in the last 50 years. And the most important rule of all? Don't panic sell. The average investor earns 2 to 3% less than the market every single year. Not because they picked bad stocks, but because they panic sold during downturns and missed the recovery. The market will crash again. It always does. And it always recovers. Always. Look, I'm not saying never buy individual stocks. If you want to put 5 or 10% of your portfolio in companies you believe in, go for it. That's fine. But your core wealth, the money that's going to fund your retirement, your freedom, your future, that belongs in index funds. Low cost, diversified, boring, and historically, unbeatable. One index fund account, this month. That's your next move. If this changed how you think about investing, share it with one person who's still picking stocks. You might save them a lot of money. And check the description. I've linked the exact funds I'd start with today.